My name is Jason Kleemeier. My business, One Wealth, is located in the Integrity Financial office. I've had a lot of questions lately about the market volatility at the end of last year, and so just kind of wanted to talk about that a little bit. There were a lot of things that went into that. Number one, investors were expecting a pullback. It had been a long time since anything like that had happened, so they were waiting for it and trying to look for reasons that might cause that. So number two is interest rates. The government had raised rates 4 times last year. They do that to kind of control companies from growing too fast, because they're worried that if they grow too fast, then that'll cause inflation and that hurts investors. So if they were raised it 4 times, they were worried they might go overboard and go too far and cause businesses to slow down. Another thing that people were worried about is the trade negotiations with China. Had a lot of issues going back and forth with China, with tariffs back and forth, and so they're just worried on what that might lead to. Another thing they were worried about is Brexit. Great Britain is working on separating from the euro, and it's just not going well. They're not sure how that's going to work out. And then finally, the government shut down on December 22nd, and so that was a big worry. Caused people not to know what to expect, and so all those things combined to cause the market to go down. I think it started down on September 25th, and it hit a bottom December 24th, and during that time period lost just short of 20%. So it was a pretty big pullback. As far as my advice on things to do is just do your best to take the emotion out of it, invest the money when you have it, or even set up an automatic investment plan where you invest so much a month or so much a quarter. It's just best to get your emotion out of it. Another thing is it's time in the market rather than timing the market. Dalbar, a market investment research company, did a study on a 30-year period ending December of 2016, and if you had invested in the S&P 500 and held it the whole way through that 30 years, you would have averaged 10.16%, but they did a study on the average equity mutual fund investor over that same time period, averaged 3.98%, and it was just because they let emotions take over, and they bought and sold at the wrong times, basically. So I'd like to help you out, though. If you have any questions or if you're looking for a second opinion, you can stop in and ask me any questions anytime. Thanks.